Okay, who's ready to start here? We've got a ton of people in the room and um, a lot of information to cover today. So I'm going to jump right into it with a update on what's going on around the world. Let me share my screen real quickly, and I want to show you a couple of different things. Um, let's see here. Let me know if you can see this screen okay. All right. This company, Glencore, is the next bank that is going to fail, and it looks like they're going to be failing here pretty quickly. So that is going to trigger a cascade effect of bank failures, and the entire system right now is nearing the cliff. We have until November 3rd before the debt ceiling needs to be increased in order to be able to pay our bills. Let me show you this quick video real quick.
Asking questions, having new
and we can go from there.
I want to get to know people and understand their ideas about everything, so you can too.
Some headlines from the Treasury Secretary, some breaking news in this ongoing battle over the debt limit. As you just saw, Treasury Secretary Jack Lew releasing a letter to House Speaker John Boehner. Lew now says the government's borrowing authority will be exhausted on November 3rd. That is 2 days earlier than some previous projections. He's urging Congress to take action as soon as possible as that showdown gets a little bit nearer than we thought.
Yeah, that looms, and it's all about what's coming in and what's going out in terms of revenues and interest payments and things of that nature. I know some have said, including our own Larry Kudlow or others, that it's not, we've had some members of Congress say it's not real. I don't think that's the case, Carl. I think it is real in terms of at least the country's ability to pay its bills.
Okay, so we've got the debt limit that needs to be increased, and I sent the email out this week, and I referenced this chart, and if anybody can get these charts, if you go to the Federal Reserve Economic Data website, this is from the St. Louis Fed, but what I'm looking at here are what we call repurchase or reverse repurchase agreements. Actually, there are repurchase agreements, and then there are reverse repurchase agreements, and what that actually means is that it's the Fed. The Fed is issuing collateral. The Treasury issues collateral to the Fed so that they can actually borrow money or print money and give that to the banks for short-term liquidity. Okay, now what I want you to key in on is 2008, when things got out of hand and Lehman Brothers collapsed, the Federal Reserve saw a spike in those reverse repurchase agreements. That was their attempt to hold the system together. That was their way of showing everybody that they had control over our monetary policy and over our financial system in America and around the world, actually, because most of these derivative contracts where you borrow money against a piece of paper or a line of credit or some type of paper collateral, either a treasury bond or anything, that any kind of instrument that the government can manufacture and use as collateral, whenever you do that, the borrowing time is very short. It's actually overnight. In the past, our country used to have a gold window that was open for overnight leveraging. They could borrow the gold, use it as collateral, and borrow against that collateral to fund their business operations. Okay, that's what banks did back before 1971. When Nixon closed the gold window, what he effectively did was he said, you can no longer use gold or gold and silver or commodities in general or real assets as collateral to borrow money to be able to fund your operations. And instead, what they did was they said, from now on, what we're going to do is we're just going to issue these short-term loans and collateralize them using U.S. Treasuries. Well, U.S. Treasuries are basically bonds, right? There's the short-term Treasury, 1 year, 3 year, 5 year, 7 year, 10 year. Then there are 30-year Treasuries, Well, if you look at the rate of return on those treasuries, the 10-year treasury is only paying about 1.8% if you held that bond to maturity, which is 10 years. And so what the government does is they issue those treasuries to the Federal Reserve as collateral for loans so the Federal Reserve can print more money, knowing that the government's going to buy those back the very next day at face value, okay, knowing that they're going to own that piece of paper and they're going to be responsible for those payments, that 1.8% interest payment to whoever eventually buys that bond from them. Does that make sense? Well, if you look at this chart, back in 2008, they were buying those bonds back at an alarming rate, the Federal Reserve was, okay? Fast forward to today, look at the activity of those bond purchases, those 10-year treasury purchases as collateral so that they can issue more credit or more debt to the banks and the banking system to fund operations. It's completely out of control at this point. What this chart shows me is that the Federal Reserve is trying frantically to preserve the way things are right now by issuing this paper, printing money, and using the treasuries as collateral for that money that they printed. Remember, all paper bills that you hold in your pocket that's not real money. That's simply an IOU from the federal government. It's a promise to pay, okay? It's backed by, if you read the dollar or read the face of the dollar or a $5 bill or a $10 bill or any fiat currency, it says that it's backed by the full faith and credit of the United States government. So the only way that they're able to get money or borrow money from the Fed and send that money to banks or to other trading institutions like Goldman Sachs, JP Morgan, Chase, even Glencore, this company we're going to be talking about, the only way to do that is for them to have good credit. And so right now the government is nearing a point where they need to increase their credit limit, meaning their debt ceiling, right, is November 3rd. That's when the debt ceiling must be increased in order for the government to fund operations. But so not only do we have that problem coming, but we also have this reverse repurchase arrangement by the Fed and these investment banks that's going haywire. And so the bottom line is that this company, Glencore, they are a commodities trading bank that is actually holding the pensions of hundreds of thousands of retirees right now. And those pensions are backed by the commodities that Glencore has purchased. Okay, now what's happened is that Glencore has been borrowing money at near 0% interest rates for so long that they've incurred or increased their debt load to over $100 billion right now. So Glencore's total debt outstanding is $100 billion. That includes those future liabilities that they have to pay out in the form of income payments to those pensioners. Does that make sense? So that $100 billion in debt is backed by only about $50 billion in assets that Glencore owns. And so what we're looking at here is, every bond or every instrument that any investment bank issues to borrow money, they also purchase what's called a credit default swap. Now, CDSs or credit default swaps, this is the 5-year credit default swap for Glencore. And you'll see the price of this CDS, this credit default swap. All credit default swaps do is they're an insurance instrument. They're insurance against the default of those pensions, of those bonds. Okay? So investors buy CDS or credit default swaps thinking that they're going to profit from that credit default swap when the company fails. Does that make sense? Now, there are sovereign credit default swaps. So I have hedge fund managers who are friends of mine that have actually bought a ton of Greek CDS, credit default swaps against Greek debt. They've bought credit default swaps against Japanese debt because they know at the government level that those governments are going to be failing, and those CDSs, those credit default swaps, will pay off big time. It's no different than what happened in 2008 with the housing crisis. In 2008, mortgage-backed securities were all the rage. Everybody was buying mortgage-backed securities, and they were doubling their money year over year. Well, a friend of mine, Kyle Bass, decided that there was no way that those mortgage-backed securities were not going to default when the housing bubble popped. So he went about buying credit default swaps against those mortgage-backed securities, and over the period of 18 months, his hedge fund grew over 800% in value. And his investors thought he was a genius. Now he's considered one of the brightest financial minds of our time. So that's what the price of those CDSs, those credit default swaps, have been doing just in the last few days. Now, if credit default swaps are going up, what's happening to the company's stock? Remember, this is one of the biggest pension funds in the world today, and this is their stock valuation over just today. You can see that from 4:30 this morning, or from 8:30 this morning, until 11 o'clock this morning, look what happened to Glencore's stock price. It absolutely went in the toilet. And so what that tells us is that this bank, this investment bank, this pension fund is about to implode. This is the next Lehman Brothers that is going to cause a cascading effect around the globe. Now, what is the effect of that to you and your personal economy? Well, if you have money in the market, or if you own stocks or bonds or any paper assets at all, I would highly, highly recommend that you get out of it immediately and put all of that money into cash or into gold and silver as a hedge. Okay. Now, when I say gold and silver, I don't mean buy paper stocks that say that you own gold and silver, because you don't want to own the paper. You want to own the physical gold and silver itself. And so if you want to get out of the market or get your money out of the market and purchase physical assets that are tangible, that have real value, instead of holding paper stocks, let me know. We can help you to do that. We have an attorney that can actually get you into a self-managed IRA or self-managed 401k, which is completely legal and follows the rules of the game for IRAs and 401ks, but your money is not in the market or with a stockbroker, for example, or an investment bank at all. So if your money is with Fidelity and they get caught with their pants down because of Glencore, which has nothing to do with Fidelity, if Fidelity folds or goes out of business, what happens to your 401k? What happens to the wealth that you built or the savings in your IRA, 401k, or mutual fund? So the only solution to save yourself from that inevitability is to get out of the market completely. And we can show you how to do that and put that money into physical assets, including gold and silver and other productive assets that pay you income or dividends, rather than just hoping that your stock is going to go up in value. Okay. So that's the key problem today, is that these reverse repurchase agreements have been going crazy over the last few days. And, right now we're literally sitting at the edge of the cliff. All right. With the impending debt crisis looming on November 3rd, where we have to increase our line of credit or our borrowing ability as a country, that has to pass through Congress. If it doesn't pass through Congress, we can't borrow enough money to operate the country. We can't borrow enough money to pay the bondholders back. We can't even borrow enough money to make the payment on the debt that we have right now today, which is that $19 trillion in sovereign debt and government debt. That's not including household debt or corporate debt or consumer debt. Okay. That's the challenge we're having today. And so, this webcast today should serve as an alert to everybody out there to get out of the markets immediately. It's getting really, really scary. All you have to do is look at some of the headlines today in some of these blogs with what's going on in Syria, with Russia and China and the United States. I mean, look at this. China says the military will stand up and use force if the U.S. sends warships to the islands. That's kind of scary to me, you know. ISIS is in retreat as Russia destroys 32 targets, while Putin trolls Obama as weak without any strategy. You know, 1.3 trillion in student debt. How's that going to be paid off? How's that ever going to be paid back? You know, 3 reasons why the Fed is screwed. So all you have to do is read through these blogs and know that we're literally at that point where, you know, 4 or 5 years ago, everybody thought that we were wearing tinfoil hats and they called us crazy and said, that'll never happen. Well, guess what, folks? It's happening right now. So the first step that I would recommend to take action to prevent a loss of wealth or a transfer of wealth out of your personal economy and into someone else's hands is to get your money out of the market where the market is completely volatile and rigged and is in jeopardy of collapsing right now. Okay. All right. So with that being said, I wanted to show everybody that article and talk a little bit about it as far as you know, how to recover from that, how to effectively insulate yourself from that. All right. The next thing that we wanted to talk to you about today was getting into why we use life insurance. And I'm launching this software right now so I can show you all this on the screen. But you know, life insurance is an asset in and of itself to some degree that you pay for on a monthly or annual basis. It's almost like having a home mortgage. Okay. A life insurance contract is essentially just like a home mortgage in the fact that you use very little of your income today to control this huge asset, which is your death benefit, right? And again, you know, if let me share my screen real quickly with you. If we go back to our old friend, the personal economic model, and we look at what that looks like, then you know, it only makes sense for us to insulate and protect ourselves somehow, some way. And so as you earn income, you know, as you get income in the door, in your income tank here from either ordinary income or other sources, and it passes through your personal economy, the first thing we recommend doing is taking a little bit of energy and effort, not letting your wealth transfer through taxes or through ordinary lifestyle expenses where you lose that money forever. We recommend that you take a little bit of energy and effort and pump that money into some kind of safe account, safe liquid account where you can have complete control and access of your money, but allow it to compound and grow tax-free. Okay. And so by doing that, all that looks like is that you're saving that in a life insurance policy. Why would you do that? Well, because you get to enjoy uninterrupted compound interest on all of your money. And what does that look like again? Well, you know, we talked about this last week. If you have, you know, if you're a 45-year-old male and you're earning about $175,000 a year and expecting your income to grow at about 3% a year roughly, which would keep it ahead of inflation, you know, no matter how much you have in savings right now, if it was to grow and compound at what the actual dividend rates are for these insurance policies, when we hit calculate, we can see exactly how much of your wealth is flowing through your personal economy at any point in time. Look at this. Just income alone between age 45 and 65, you're talking about $4.7 million worth of income flowing through your personal economy. And so again, the question is, how do you control and capture that income and not transfer that wealth into someone else's hands? And then if you add the savings on top of that, whether it's from an IRA, 401k, mutual fund, or just, you know, other assets that you own, whether they're physical or not, you're talking about $9.3 million in total wealth that's flowing through your personal economy. And so again, how do you capture and control that and not transfer that wealth? All right. You know, the wealth transfers that we all experience are real, and they're huge. You know, most of us, if we're in the 30% tax bracket for this same, you know, scenario, look at that. Over the next 20 years, you're talking about $2.5 million of your own wealth transferring to Uncle Sam. And what's worse is not only does that wealth transfer to the government, but you no longer get to earn any interest on that money at all. You never get to recapture it. It's gone forever, and you never get to earn interest on those dollars. And so, you know, again, instead of doing that, why not capture and control that wealth? Well, debt service is no different. You know, in order to qualify for a mortgage today, the maximum debt to income ratio that any loan officer will accept or any bank will accept is 35% debt to income ratio. And so if you look at that over a period of 20 years, you're talking about $5.6 million of your wealth transferred in just taxes and debt service alone, if you're using your own money. And again, those dollars are gone and lost forever. You can never recapture them, and you can never earn interest on those funds. All right, but it doesn't stop there. We also transfer our wealth through paying ordinary lifestyle expenses. Now, most people will tell you that we spend anywhere from 20 to 40% on our lifestyle. And that can include anything from, you know, college tuition to ordinary living expenses, your mortgage, your insurance payment, your car payment, you know, your credit card, your boat payment, all of that stuff. And if you were to do that and pay those bills without any regard for your personal economy, you'd be transferring $8.2 million in the next 20 years out of your own personal economy. The first thing you should notice or recognize is that it gives you very little of your own money to start saving. Whoop, sorry about that. Do this again. So how do you prevent that from happening? How do you not transfer your wealth unnecessarily or unknowingly, but instead keep and control all of that wealth? Well, the way we do that is through life insurance. And again, going back to our personal economic model here, as money comes into your personal economy through either ordinary income or inheritance or other things, even if you win the lottery, it doesn't matter. We just simply take a little bit of energy and effort, pump that money up into your personal economy or into your reserve capital account, all right? And then when it's time to use that money, all we do is we simply collateralize those funds, and we borrow against that account and use the life insurance company's money instead of our own. Why do we do that? Well, number one, it's considered a loan and not ordinary income. Loans are not taxable by definition. They're a loan. They're not income. They're not considered ordinary, passive, or portfolio income. Therefore, they're non-taxable. So right away, you can see that if you're using funds that are borrowed instead of using your own money, you're not going to get taxed on that money at all. And it allows your money to go and grow and earn uninterrupted compound interest on a tax-free basis, okay? Now, as new money flows into your personal economy, where do you put it? You got to put it somewhere, right? Your choice. You can either put it into a risky investment, or you can put it into your life insurance policy and then pay that loan down and let all of your money grow and compound and add more to this bucket here, okay? And so that's technically how we do this. That's the key secret ingredient to controlling your personal economy, is to let all of your money compound and grow and earn uninterrupted compound interest, but still having liquidity and use and control over those funds through loans, through policy loans, or by collateralizing this account. You know, you don't have to use the life insurance company's money. you can borrow the money from other sources and simply use your cash value as collateral against those loans. You know, if the life insurance company is charging 5% interest, but you can borrow money at a bank for cheaper, and you have the flexibility of paying that loan back whenever you want to. In other words, it's on an unscheduled repayment situation, then you may want to decide to do that. But if you have to pay that back at a certain period of time or on a certain schedule, like a 401k loan, for example, how much does it make sense? You know, does it make sense to you to borrow against your 401k versus your life insurance policy? I don't think it does. I would prefer to borrow against a life insurance policy just for the simple fact that if the 401k goes down in value, you could have a margin call on that loan, and that loan would be due and immediately be due on demand, essentially. Okay. With a life insurance policy, if you borrow against it, you get to repay those loans as you choose on your own schedule, on your own time frame. There's no specific repayment schedule of these guaranteed loans. You also don't have to go through any qualification for the loan. The insurance company simply places a lien against your insurance account, your cash value in your policy, and borrows against that account, all right, using their own funds. But, you know, the dirty little secret in the life insurance industry is that life insurance companies, they really hope that you never, ever, ever repay these loans, and that they just continue to compound and grow to where when you die, they won't have to pay out a death benefit. That's what they're hoping for. That's the dirty little secret. What we do is we just simply trick the insurance company and we repay those loans so that we can release that lien and do it all over again. As you pay back that loan, it simply releases the lien against your collateral. Your collateral grows and you can add more to the account, and then you simply just rinse and repeat. You can borrow against those funds again and do the whole thing all over again. You can use that money as income, or you can use that money to invest. All right. So even if you have an investment opportunity, you can borrow money against your policy, use that money to invest, and then just repay those policy loans whenever the investment pays back. Make sense? All right. So that's the key to controlling your personal economy. Now, there are several different accounts that you can use to control your personal economy. You can use a 401k. You can use, even a CD if you wanted to. Let me show you here real quickly. Here are the different types of accounts. If you use a 401k, you get tax deferred growth on your money. You do get competitive returns. There are some additional benefits, and you can deduct your contributions from your income, right? It's tax deferred money, but it's not a safe harbor. You don't have collateral opportunities. You can't invest whatever you want into a 401k. They cap you at a certain amount of money based on certain factors. And when you use that money in retirement, it's taxable as ordinary income. So not the best way to borrow and control your personal economy. If you use a CD, you can put more money into a CD and you can use it as collateral. It is a safe harbor and it does have some guarantees in there, but you're not guaranteed loans against it. And you have to pay that back on a certain repayment schedule. If you don't, then the bank just simply keeps that CD and you lose the asset itself. All right. You can do a margin account on a stock portfolio where you do get competitive rates of return and you can contribute a lot to the account, the stock account. You can borrow against the account, but again, you are guaranteed loans against the account. You do have liquidity, use, and control. But again, you got to pay those loans back at a certain schedule, or they take your account away from you. They just simply keep your stock. All right. You can use real estate. You can do a home equity line of credit where you get tax deferred growth on your real estate. You can borrow the money against the property, collateralize that asset. But you have to pay the loan back on a certain structured repayment schedule, and it's not a safe harbor. If you're sued by anybody, they can claim that asset and take it away from you. All right. You can use a savings account or a money market account, but the best place to use this kind of strategy is with permanent life insurance. Why? Well, because it allows you to grow your wealth tax deferred over time, because you're not touching it and it's growing tax deferred. You get tax-free distribution through the loans. You get competitive rates of return. You're actually earning dividends into your account, not just inflated rates of return through stock portfolios or through some kind of market that you're tracking, like the S&P 500 or any other index. There's no volatility in the permanent life insurance, in the whole life contracts, like there are with the index policies. You also have additional benefits like long-term care and accelerated death benefit. If you were to have a debilitating illness or get into a car accident and require long-term care or some kind of 24-hour care, if you're in a group home or a assisted living facility, they can accelerate the death benefit tax-free to help cover the expenses of assisted living facilities. You get collateral opportunities. You're guaranteed loans with these accounts. It is a safe harbor for your money, meaning it's lawsuit proof, judgment proof, and creditor proof. Nobody can touch this money except for you. It's a trust. Back in the 80s, Congress enacted laws that protect life insurance as a trust, and they made it lawsuit proof, judgment proof, and creditor proof. Not even the US government can touch this money. Okay. You don't have to repay the loans on any particular schedule. Remember, the insurance companies hope that you don't repay the loan, because what they want is for you to die, have a huge outstanding loan balance, and then they don't have to pay a death benefit at that point, because the loans that are outstanding would offset that death benefit. All right. You have full liquid use and control of your money. You can use it for anything you want, and you can deduct the contributions if you structure the policy correctly. Let me say that again. You can deduct all your contributions if you structure the policy correctly. Okay? So that's why we use life insurance as a great way to control your personal economy and to insulate and protect yourself from the chaos and confusion that is the global economy. All right? Life insurance companies, by law and by definition, are forbidden from being involved in the banking system and Wall Street. They can't invest your money into shady deals like derivative contracts, mortgage-backed securities, or credit default swaps, to be honest. They have to invest your money in tangible assets that pay income or dividends. And those are things like roads and bridges, toll roads and toll bridges, and buildings that are rented out or leased. The example I always use is the New York Life building in downtown Manhattan in New York. New York Life has owned that building since 1828, and every floor of that building has been leased out, fully occupied since 1828. So you can imagine the revenue that's generated from that one building over time, over the last 100 years or so, 150 years, right? It's consistent income to them. Well, these insurance companies, what they do is they invest in projects like that are not leveraged but owned outright, and all the income is paid as dividends into your account, and they take their fees out of that. Okay, that's how they make their money, is through fees. So totally different world than the investment banking world, and completely safe and very useful to controlling your personal economy. Okay. Does anybody have any questions right now? I'm going to stop sharing my screen real quickly and check on you. Wow. Looks like we got a lot of people in the room. So let me know if anybody has any questions. Go ahead and type it into the chat box. What I've got right now is an offer that I'm going to leave up here for a while. But what I'd like to do is offer you a free 50% off of your annual subscription to our membership website, where we do ongoing coaching, one-on-one and group coaching around your personal economy to help you maximize and insulate that personal economy from what's going on around the world. Okay. And so this is good. I see a lot of you are taking advantage of that. Some of you are taking advantage of that. Because I have a limited availability and a limited amount of time, I can only really talk to the first 25 people who want to join this movement that we've got going on here. So join now and use the promo code. Here's the promo code. I'm going to type it into the chat box right now. So if you're joining us live, then you can get 50% off of your coaching by entering in this coaching, this code that allows you the discount. It's a discount code. All right. So if you want to join our group, our tribe, as I call it, click the Join Now button, and that'll allow you to join the tribe at the Strategic Wealth Network. It'll give you full access to all of these learning modules, and you'll have 100% access to myself and my team to answer any questions that you may have about your personal economy. At the very least, I would recommend strongly that you call us, that you go through an analysis of your personal economy so that you can actually get an updated report on how you're doing, so that you can track your progress and make sure that you're on track and you're not getting caught off guard by what's going on in the marketplace. Okay? So I'm going to leave this offer up here for a little longer. I see that more people are joining. This is great. They're looking at it at least. If you use that promo code that I typed into the chat box, then that'll give you 50% off the pro annual subscription. You know, like I always say, you can hire a financial planner. And if you have an account with a financial planner, and let's just say you have, I don't know, $100,000 placed with a financial planner, that financial planner is going to charge you 2% a year, regardless of whether or not that money goes up or down. So just imagine that you don't make any money off of your account. You don't grow your wealth with that financial planner. And the money that you have in that account stays at $100,000 a year. Well, if that were to happen and you were being charged 2% a year, after 10 years, you'll have paid that financial planner $20,000 for absolutely no return. Absolutely no return. By becoming a member at the pro annual subscription level for the Strategic Wealth Network, you save all of that money and you have access to some of the brightest financial minds of our time, including hedge fund managers and other private equity managers, where you can grow your wealth extremely fast in a safe environment where you're hedging against the downside of the market collapse while everything's shaking out, and you're still growing your wealth through alternative investments and through other strategies. Okay. I encourage everybody to jump around the site, read as much as you can. We have a great blog that we've put up. I contribute to that blog on a regular basis, and there's some really useful information in the blog just by itself. But I encourage everybody to join, and it looks like we only have six more spots left on our site, it looks like, before we're going to have to close this out. So if you're on this call or if you're on the replay, download the Fact Finder worksheet. You'll find that on the blog on our site, and get in touch with us so that we can give you a free analysis of your personal economy. And if you're interested in joining, I encourage everybody on this call to join our tribe as soon as you can, sooner rather than later, so that you can learn the secrets of protecting and insulating your personal economy right now while we're going through this crazy, volatility, this crazy time around the world and with our markets. All right. I'm going to bail out right now. Looks like everybody is well, a lot of people are jumping in and joining. That's awesome. All right, we've got one spot left at the 50% off this pro annual subscription level. So if you're on this call, I would highly recommend you grab it now. That way you can join our tribe, join our movement, and learn as much as you possibly can about how to protect and insulate your personal economy, just like the wealthiest families do in America. Okay, I'm going to leave now, so I will talk to you next week at our next coaching session. Everybody have a great week. We'll talk to you soon.